So good evening once again to all who sort of really take time out to listen to us. We believe, as the topic for today's discussion is private debt, and we believe this is a very, very compelling asset class, which has largely been underrepresented in investor portfolios, and we believe it definitely merits an allocation from across investor classes. Let's sort of try and understand as to what exactly do we mean by private debt and what all does it sort of really entail, and why we believe that this is an asset class which sort of really merits inclusion in portfolios, and how is it that you can really participate in this segment of the market. Okay, so sorry. Yeah. So let's understand what exactly do you mean when you talk about private debt. So I'm sure everyone sort of fairly well understands the different asset classes that are there, and largely if you look at it purely from an investor allocation perspective, it is split between two larger universes, if I may sort of really classify them as. One is physical asset and one is financial asset, right? So physical asset is largely been real estate and gold. While a lot of newer segments within that of art and a lot of exotic variety is there, which is sort of now making it mark felt in India. But largely, as a country, as a market, we've been on the physical side have been with real estate and gold. While the other segment, which is financial assets, have also sort of really gained prominence over the last 5-7 years. And sort of the weightage within investor portfolios of those financial assets has started to kind of really increase. And we all know what has happened overall from the kind of participation that we've seen in financial assets from investors. And it's only sort of really, is believed that it's only going to grow from here. And, this weightage, which was largely skewed towards physical assets, will get, incrementally be allocated towards financial assets. And financial assets, again, largely is between equity and debt. And then you have hybrid, right? It's a function of what all, how much of a proportion of equity. And equity, again, can be further sort of looked at and divided into listed and unlisted, right? I think what we've all been witness to, in this country has been this unprecedented kind of interest from overseas investors, venture funds, into the unlisted segment, which is also early stage venture investing, as well as even sort of advanced stage entities which have drawn a lot of attention and attraction from investors, both domestically as well as globally, wanting to look at these startups in India, and purely from an equity aspect. Similarly, so just as you have listed and unlisted equity, you have debt which is listed and unlisted. Right. So private debt is nothing but essentially debt given to this unlisted segment of the market, which is, I mean, quarterly wise speaking, this is like, where you have unlisted equity. Similarly, to those entities which are unlisted, the amount of debt that is sort of really made available to them gets classified in the private debt. So what happens is, so there are a lot of companies that we know which are unlisted, and and you can see a lot of these logos here on your screen. This is just a sample set. This is not exhaustive. This is a few names that we could sort of really wanted to put them out and then draw attention to the fact that these are sectors and segments of the market which also need sort of debt to grow. Largely, as we've seen, equity is needed by organization and sort of raised by entities, largely from a valuation perspective. While for a growth in the business, debt is something that you really need. So from expansion purposes, for working capital, is where sort of really debt comes into play, and then sort of really is needed across the spectrum of businesses. So it is not just your listed players. There are these unlisted players, and these new age businesses also, which we need capital to kind of really expand and grow. This segment of the market, which is private debt, has historically been sort of catered to by banks and NBFCs. And which of late, over the last say about a decade or so, have now kind of really moving slowly, gradually out of that stronghold of banks and these large NBFCs, with a lot more specialized players wanting to look and explore these and offer these kind of solutions from a debt point of view to these entities. And why is it that? Because largely these new age business models that are evolving, which are more IP driven and sort of less from a collateral aspect that these entities would have. Then banks have traditionally found that segment of the market very difficult to kind of really provide capital to. And that's where you need, and you've sort of really seen the emergence of private debt players who sort of really make this capital available to these segments, where you sort of really put in new models to understand the businesses and the kind of metrics that they work on. And that's where this whole category has sort of really emerged. And the other aspect is not just the fact that these the non-traditional players who sort of really have been providing capital. Investors or even these entities have largely looked at either raising equity, and which is private equity or venture investing, as well as the fact that beyond a certain point of time, you don't want to kind of really dilute your stake in the business, and hence comes in a category which is venture debt and even private credit, private debt. So that's how this whole space has evolved, and we believe that it's very you're still pretty nascent, at a very nascent stage in India, and we believe this is going to really scale up and become a very, very prominent asset class, as it is globally. Right? Globally, it's a very, very large asset class, while in India, we've just started to kind of really get a large part of acceptance from segments of the markets which have traditionally not participated. When we're talking about private credit, private debt, and where does this kind of really get allocated? It is again broadly split into two segments, which is performing credit and the so-called non-performing credit. I mean, for a lack of a better word, we've sort of really put it as non-performing credit. But what we largely, sort of are referring to here is, your distressed assets, special situations, kind of opportunities, which also have sort of really emerged after a lot of changes that the government has done from a policy perspective. So you have NCLT today, and a lot of, so there is bankruptcy proceedings that keep happening with entities today, and there are these specialized, managers who sort of really come in and then, sort of take over those opportunities and then sort of participate. So they have traditionally, this segment was non-performing, and when you have these specialized managers who come in to kind of really, make inroads and then try and sort of really rectify the situation and then convert it into a sort of a viable performing entity. While the other segment, which is private credit or the performing credit, is something which is again catered to those segments of the markets, which are not your typical cash burn businesses, right? So there is an evolution within within an entity. From a very, very early stage where you would need some amount of equity to kind of really, have some kind of a capital to kind of really scale up the business. Then you, beyond a point, when you have, proof of concept and you have acceptance and, traction built into the business, you initially take those, that equity is kind of really used, and there is this so-called capital burn, which happens to kind of really get to this proof of concept, and then sort of really have transactions and acceptance from investors and even users of the product. So from there, that you can really, when you've established the concept, you want to kind of really scale it up, is when sort of really, and you moved from a cash burn business to a positive unit economics, so to say, where you are not kind of really burning cash anymore. And so there is metrics which has been established. It's just that it needs to kind of really scale up. That's where is what we refer to performing credit, which kind of really comes in and takes over. There have been, this is largely in India, is right now being catered to by AIFs and these private debt funds. And the big difference over here versus other structures is the fact that what you have is higher returns. It can be structured in a manner that you can get higher DPIs, which is nothing but distributions paid in capital, and so your actual cash which is received. So there is a targeted IRR at a fund level, and and typically these funds have, say, 3, 4, 5 years or even 10-year kind of a tenors. And till for an investor, he needs to kind of really realize these gains rather than just sort of really see the paper value can really go up and NAV go down. So how do you do that is when you sort of really structure it in a manner that there is constant kind of cash flow that happens in these targeted returns that are there, are paid out in the form of quarterly coupons or half-yearly coupons, or in some manner that this is sort of realized by investors. Yeah. Okay. The other aspect. So I just saw this one message saying that instead of calling it non-performing, can we not call it under-penetrated? So we believe that private debt as a sector or a segment is itself is under-penetrated. The difference I'm really trying to sort of bring about over here between performing and non-performing is the fact that there is a proven business model which is not sort of burning cash today and is sort of unit economics positive, is what we call as performing credit. And the other segment, which is on the other side, which is already sort of really got to a situation where a large part of the net worth of the organization has been depleted, is then sort of really becomes non-performing in that aspect. And that needs to then kind of be turned around. And therefore, you need specialized managers who can really come in and put in that much amount of, sort of understanding, and then sort of redo the whole business to kind of really make it and move it towards a performing credit space. And this is again been largely being played out in India, via AIFs and structured product platform. Rather than the traditional sort of MF platforms, which have historically been there and have largely operated in the listed segment. So as we said, there is a listed debt and or rather public debt, so to say, and then there is private debt. So listed or public debt is largely what is catered by mutual funds, and where investors have been participating over a period of time. And the other emerging space is what I'm sort of really talking about is the private debt segment, which is unlisted, and which is right now being catered largely. And we believe that AIFs and structured product platforms are better vehicles to kind of really take to participate in this segment, rather than there are multiple ways, and I'm going to talk about that in the subsequent slides. But we believe the most efficient and a better way to play this out would be via AIFs and structured platforms. And the last is the yield that this kind of really segment currently operates and provides is largely in the 11 to 15% kind of a rating rate or a return range from an XIRR perspective that this sector segment provides. I see another question which says, what is the full form of DPI? And that is distributions paid in capital. So this is, again, if I may loosely use the term, your dividend payouts or your coupons that are paid out to investors is what is sort of really captured in DPI. So the other aspect that I wanted to sort of really refer to here, as you can see on the screen, are these sort of names of these new age businesses, and these are largely what you have on your screen is non-FI, right? So again, if you look at the whole market, it can be divided between FI and non-FI. So FI is financial institutions, so which is largely your NBFCs and financial institution platform, and the other is the non-FI, which is your manufacturing and these so-called corporate finance segment. So while what you see here is largely, because why I wanted to also have these names is to really also bring an association with the audience to understand that an entity like say for example a Sood Healthcare it also needs debt to grow, right? Today we've had an IPO start for the most talked about one entity called Nykaa, right? Nykaa also needs debt to kind of really scale up the business. So as an entity like a lead school, but financial institution segment, say for example NBFCs. For NBFCs, capital is raw material, right? And they will constantly need to raise capital to kind of really expand and grow their really book size and their business. So that segment is already there. But I also want to kind of really bring about this point very clearly to the audience that this segment, which is largely understood that would not really need debt, it actually needs debt to scale up, because as I said earlier, equity is more from a valuation perspective. What you can really for scaling up business, you need really a debt to kind of really scale it up. Yeah. So coming back to the point that I raised as to where does it sort of really fit from a risk return kind of landscape, if an investor was to kind of really look at this as an opportunity. So it's very, very sort of so there's a kind of a white space which is there, which is beyond your AA rated bonds, which has largely been again to a large extent catered by mutual funds and been largely in the listed segment. The unlisted segment is in the, as I said, 11 to 15% kind of a risk return landscape on the overall chart. And so what you need to kind of really look at it here is where does it sort of really fit in from the overall investor portfolio perspective. So it definitely warrants an allocation, because we believe that if you do the risk management right, and you sort of largely from an incoming investor perspective, until unless he understands the risks that are involved, performing credit, we believe is a better sort of a stepping stone into private debt, rather than sort of really just jumping on the other extreme, which would be the so-called non-performing credit and distressed asset and special situation kind of opportunities. Venture debt is something which kind of really sits at an earlier stage than an entity before it sort of really gets handed over to the segment that I've been addressing as private credit or performing credit. Is so these entities which are at the stage where they are cash burn businesses, they've sort of really got some proof of concept, they've raised a large amount of equity, and now they don't want to kind of really, now that you've proven your concept, you don't want to really dilute further equity, but you want to scale up. That's where venture debt as a sort of an asset class steps in and provides you that much amount of debt capital to kind of scale up. And then they take a certain portion, a very small portion in the form of warrants on milestones. But it is a little early stage than pure play performing credit. So these entities will largely evolve and sort of really get classified into the performing credit space over a period of time. But that's where venture debt steps in and picks it up early, and hence there is that amount of the so-called risk premium that a venture debt delivers over a, say, a pure play performing credit. So here, the ability to structure, and hence, as I said, not just AIF, but the structured credit platform is what is required for them to kind of really design something which is what is relevant to a certain investor segments. So that's something that we at Northern Arc continue to kind of really do. So there is no one size fits all, right? So there is a risk appetite. There is a segment of the market which would need a structure which would say a shorter in tenor, someone which needs a medium term, someone which needs long term, and then the payoffs need to be sort of in line with the kind of risk that sort of long term comes in, then short term and sort of medium term sort of really comes in. And then if you want to kind of really bring in some amount of tax efficiency, or you want to bring in some amount of regular cash flow, so all of that can be done. And that's where we believe largely mutual funds, the way the SEBI regulations are today, they've been kind of straitjacketed into this is what a credit risk fund can do. This is what, say for example, even in equity, this is what a mid cap is. This is what is flexi cap, and this is what is say large cap. So all of that is is pretty much standardized and defined as to what you can do there and not do there, and hence the ability to structure something depending on the investor class is where the structured credit platform sort of comes into play, and even in AIF then offers a better vehicle to participate in that segment. And then, as we all know, the higher the risk, the higher the reward, and then as you can really go up the sort of risk return ladder, then there are these venture capital funds, and then there are these collectible funds, and a lot of that angel investing space, which has gained a lot of traction with the kind of kind of unicorn kind of spree that we've had in India this year, and gain a lot of sort of buy-in from various investor classes, right? Not just the most sophisticated and institutional investors, but even family offices, and even ultra HNIs, and even people who don't really understand too much of it, but would, because this is a fad, would want to kind of really participate in that. So what we believe you need to do is to kind of really have your asset allocation defined, and then basis that we believe performing credit in the in the private debt space should be a class that can sort of really warrant allocation across investor classes. Now, coming on to the point as to once you've identified that this is a space of an asset class that warrants sort of allocation, how do you participate in this, right? So there are broadly three kind of ways and means by which you can sort of really participate here. And one is direct participation. The other is syndicated offering, and the third is a specialized fund manager. You go with a specialized fund manager who sort of really brings in that much amount of a so-called understanding and then structuring it to your requirement. So there are certain pros and cons of all. I want to kind of really draw attention to all of these, sort of ways and means, and then leave it for the audience to kind of really take their own sort of calculated call as to how do you kind of really would you want to participate. So direct participation is where you have a lot of these emerging platforms which sort of today offer you again a standardized a paper which is then sort of originated and then sort of distributed to investors across the length and breadth. So that is where you need to then go ahead, identify those platforms, do your own research on that paper, and the entity that you can really getting into, and then sort of really go ahead and buy that sort of OTC product, as we would like to call it, and then sort of hold on to it and then see the payoff. While a syndicated offering is where a large part of the initial one is origination, and as well as the other part is the kind of diligence that is done by a syndicate, a player who's syndicating for a particular paper has done that initial bit and then showcase that to you, and then it sort of becomes more of an investment banking relationship, where I come with an opportunity to you and showcase it to you, and then you take your own calculated call, and I will help you execute the transaction. So these are two ways, and the third is, as I said, the specialized asset manager, where he is understanding the requirement and then going back. So it's not sort of a one-way street, so to say, where there are these ideas which are originated and then sort of really presented to you. There is a lot of kind of discussion which happens between what is it that an investor segment wants, and then you can really structure it in a manner that it sort of meets the requirement of the investors. So that's where you have a specialized fund manager who comes into play to then offer that kind of a solution. So again, the parameters are investment avenues. So so direct participation in both the direct and syndicated platforms. It is more of a direct participation. You will need to really co-originate and not originate, but identify these platforms and then sort of really go by what's being offered at that point of time. And then that sort of changes with a bespoke solution that a specialized fund manager offers. The second aspect is the due diligence support, right? So in both the other methods, which is the direct and syndicated platform choices, there is diligence, which is the initial diligence to a large extent done by the platform provider, and then you need to really understand as to is that something that is sort of meeting your requirement or not, and then basis what's available, you can really take it or you don't. And then the due diligence support that a specialized asset manager will sort of really bring to the table is not just in origination, but also tracking and monitoring, right? So there is constant, so it's not a fill it, shut it, forget it model. You don't just sort of really buy a paper and hold on to it and then sort of really wait to maturity. You need to constantly keep monitoring what's happening, right? So that's, historically what has been the case has been that, whenever people have bought papers, then you wait for a rating action to happen. And if it is, a negative action, then, you sort of really, it's already too late for you to do any action at your end to be able to kind of preserve value in that investment. So what we believe is a better model, and what you do in portfolio monitoring is to constantly keep evaluating as to how is that entity doing, and what are the red flags that you see early on. And if you see those, and then you can really step in and sort of really take action to make sure that you preserve value, rather than, you wait till the end where, a large part of the value is already eroded, and then you are kind of really left with holding the crybaby, so to say. So while, the monitoring aspect after origination, and you sort of really taking the transaction or completing the transaction on the direct platform or on the syndicate platform, then that monitoring aspect is actually left to you as an investor or an advisor to kind of really then monitor what's happening there, unlike what a specialized manager has explained. The second or the other aspect is the standard, sort of a portfolio approach, rather than having one or two papers via the syndicate platform available. So fund manager gives you the diversification, which typically, like how a mutual fund operates, it gives you access to sort of really putting your eggs in different baskets and not just in one basket. And then there is largely an alignment of return expectation, right? So as I said, in direct and syndicate, there is something which is available. You take it or you don't. So it's an OTC product, While with a specialized fund manager, you have the ability to kind of really structure something as per your requirements. So you might have a requirement which is, say, yielding you a 13 or 14% post-expense pre-tax kind of a return. And there is a certain amount of risk that comes with it, but that can still be structured basis your requirement. While, you know, in these platforms, what is available is, if you like it, take it, or else leave it. And then the reporting mechanism, right? As to, there is no reporting which happens, unlike a fund manager where there is constant sort of an update with what's happening with the underlying portfolio, what's happening with the entire sector and segment that, you know, the portfolio is created around. And with events like, you know, COVID, you know, the kind of impact because of the lockdown, or, you know, with businesses kind of really losing kind of volume or traction, what is the impact on the balance sheet of these lenders which were really provided them, or even for non-FI, you know, the kind of impact that the entity would have sort of really taken because of, you know, this kind of a pandemic impact. So that's, we believe, you know, a specialized fund manager, in short, becomes a better vehicle to kind of really play this segment. And then sort of really participate into this emerging asset class. While there is, you know, there is, as I said, there is no one size fits all. And again, I keep going back to that same point. So if you believe that, you know, you as an investor or an advisor have the wherewithal to kind of really track it, monitor it, originate it, and also take corrective action, then definitely you could go ahead and sort of really, you know, go onto the direct platforms or go to the syndicated offerings that are available. So to sum it all up, you know, we believe that this is a very, very compelling, large market opportunity, which is there. And with sort of the amount of, you know, new businesses that are now, you know, sort of really being able to access capital, which was traditionally not available to them. You know, the kind of scale that we believe that will emerge over the next 5-10 years is quite a compelling kind of a market size. And for an investor, we believe that's a very relevant segment to kind of really allocate and look at and participate, you know, depending on the vehicle you want to choose. And again, as I said, go back to the same point, you know, mutual funds have largely operated in the public, you know, market space or public debt space, and have largely ignored the private market space. For, you know, historically that space was still very small, and as we believe that is sort of really becoming large, we believe the AIS and the structured platforms will really become better vehicles to play this out. So this is largely what I had to talk about. I'll quickly give a quick rundown on what we do at Northern Arc, and you know, we are one of those select few private debt platforms which sort of really provide a solution end to end, right? So from a direct origination platform to something like an Altify that we have, to you know, from a syndicate offering is something that we also do at Northern Arc Capital. Then to, you know, the specialized fund manager, which is Northern Arc Investment Managers that I represent, is where we sort of really do manage products depending on the investor requirement. So the entire three you know, segments, you know, which I spoke about, are what we offer as an entire sort of end-to-end debt platform. And we've been doing this for the last, say, 13 years plus. And that's where we believe that, you know, we have a fairly good understanding of the segment. And we believe that, you know, this then becomes a better sort of way to kind of really participate there. We've largely been an institutional oriented player. And so, you know, so we work very closely with, you know, all institutional investors from the likes of banks, be it private sector PSUs. We work with DFIs, both domestic and global. We work with mutual funds. And globally, as you can see these names here on your screen, a lot of these multilateral organizations, whenever they are looking at these sectors and segments in India, they invariably route those investments via Northern Arc for the amount of knowledge capital that we bring to the sectors that we operate in. or they co-invest with us, into these sectors and segments in India. So we've cumulatively done about 1 lakh crore plus kind of an aggregate, capital. We facilitated that kind of number to these 230 plus companies that we've been working with over the last decade plus. And we believe that, this scale is kind of really, as it's kind of really grows, we think we will be, we'll be at the forefront of leading this segment of the market. And I will now want to take a pause here and sort of really take any question that you might
have. Thank you, Mr. Malik. So all the participants are requested to post the queries on the chat box. I will take up I'll see the questions and yeah. So the first question is from Mr. Raghavesh. Public markets have been able to attract good talent due to the large ticket size, while PE VCs have been able to do the same due to high returns. Will private debt space be able to attract the same quality of talent?
Correct. In fact, we have started to see a lot of talent and even interest from global, these established players, be it private equity funds or specialized, private debt fund managers wanting to look at global ones, wanting to look at India and sort of really set up shop. And that's where, as the sort of really segment can really scales up, that's where so there is where the talent then comes in. We've already seen that start to play out over the last a year and a half to 2 years, and we believe this is just the start, and we believe this will kind of really scale up pretty strongly.
Okay, so the next question is from Padmavati Selvam. Any credit rating support is available before investing in private debt?
Correct. So very valid point. Yeah. So while there is, the entire segment, that is available, and this is right from unrated to investment grade rating to right up to, say a AA minus, kind of a, space that rating is available. It's just that, it was a small segment earlier, and hence can really was possibly would have missed a lot of investors sort of focus, but it's something that has always been there and continue to be available and has sort of really grown in size.
So the next question is from Mr. Ramnath Rao. Is Northern Arc sector specific or agnostic? What are the criteria for investments?
Yeah, so Northern Arc, we are not agnostic. We are sector specific. So we look at as I said, performing credit as a space, and within that there are these sectors and segments that we operate in. There are largely about 6 sectors that we operate in, and so I'll just sort of name them out for you. So we work in we finance microfinance players, vehicle finance players, small business loan players, affordable housing, agri finance, and this new age corporate finance. And not just your traditional capex, cement, steel, textile sectors.
Okay. So the next question is from Dr. C. Jayashree. How is green sustainable private debts are booming in debt market?
So I didn't follow that too clearly, but as I understand that you're talking about, sort of the ESG segments of the market, and is private credit also a vehicle to participate there. We do believe that is also a segment within private debt which is already attracting interest. Very, very early stage, but we at Northern Arc work in that space right now. And that is something that is also there and has been sort of really gaining traction.
Okay. So the next question is from Mr. Vishal Navlani. He's asking us, as an investor, what is the minimum investment one can start with to be associated with your company debt instruments?
Okay, so just to kind of really reach it, so there are two things here. One is if you want to participate in debt to Northern Arc, or if you want to kind of really participate with the private debt as a segment through vehicles provided by Northern Arc, right? So we offer both the options. So Northern Arc also does raise debt, and we need, as I said, we'll constantly need debt to keep growing, and that is something that keep happening at at a regular point of time. As of now, we don't have any issue on. Feel free to reach out to us or visit our website for more details. While for the the ticket size point there is 10 lakhs is the minimum, and this is now a regulatory requirement that any sort of offering has to be with a minimum ticket size of 10 lakhs. So that is where it is. And then from the funds platform, there are AIFs, and then we also have a debt PMS. So debt PMS and AIF with regulation requirements of AIF 1 crore as the minimum, and PMS is 50 lakhs as the minimum. So all of that is available.
Next question is Mr. Hemant Gupta. There are a lot of PE which are also now venturing into private debt space. Wanted to understand what is the total size. Just a second. Yeah, wanted to understand what is the total size of this market and who are the key players in this space.
Sure. So yeah, it's a very large market, and as you rightly said, a lot of private equity is sort of gaining a lot of interest into this segment, and they are setting up private debt sort of vehicles to kind of participate there. So just to kind of really give you a size, because the entire all the entire sectors are available, right? And as I said earlier, that we as a house operate in select 6 sectors. So there, the size of the market annually is anywhere, the amount of debt that is needed by these sectors is anywhere in the region about, say, 2 to 3 lakh crores is the need right now. And this will sort of really, as companies evolve and they move to performing credit, this is only going to grow. But at a overall level, it would be, it's a far higher number. I don't have that offhand. So I would not like to comment, but the space that we operate in annually, the requirement is anywhere from 2.5 to 3 lakh crores kind of capital.
Next question is from Mr. Viral. He's asking, how is the security or collateral structured in India? Is it like direct lending to companies where future cash flows are being looked at, or is it some hard assets or shares separate from operating company cash flows?
Correct. So it again depends from sectors to sector to sector. So largely, when you talk about FI lending, which is financial institution lending, for financial institutions, they don't really have too much of hard collateral, right? And so there, for an NBFC or a financial institution, their receivables is essentially the asset that they have. Those become the collateral that is available on the structures that you want to do. While for non-FI names, again, as I said, this segment has largely been sort of catered largely by these new platforms than your traditional banks, because those structures from banks wanted hard collateral, which is something that even a lot of these new age businesses don't have. And then how do you structure the the sort of lending structure to be able to have collateral, and while it could not necessarily need to be hard, which is something that these entities might not have. And that's why you need to kind of really have a very specific kind of a solution to every lender, rather than have a blanket kind of a format.
Thank you. I hope there are no more questions from the participants.
I see one. This is from Padmavati Selvam. What is the regulatory framework of alternate investments? I'll quickly answer this. And yeah, so there is, so alternate investment funds today are a very large segment. This whole space was kind of really launched as regulations were launched in 2012 by SEBI, and constantly is sort of evolving from an regulatory framework perspective. And today, this space, AIFs today manage about 7 lakh crores worth of commitments across category 1, 2, 3 AIFs, and then within that you have roughly close to about 4.5 lakh crores, that is the drawn down capital. So it's a very large market, and which has sort of really sort of grown in the last 3-4 years, or rather 3 years in particular. So the regulatory framework is already there, and it keeps sort of really improving as as new structures get kind of really launched in India.
Yeah, so one more question.
Yeah.
Is from Mr. Manish Gar. With lending to FI or NBFC sector, there are a lot of issues in terms of receivables due to COVID or bad loans. How does recovery happen in venture debt, as this was collateral?
So within FI and NBFC also, while again, there are sectors where they've taken a large hit because of the way COVID sort of really played out. But there are sort of segments within the NBFC space which have not really been as badly hit as being perceived. So then you need to kind of really, as I said, you need to kind of really keep constantly monitoring what's happening. While for your question on what's happening with venture debt also sort of really, again, collateral will not be there, besides the fact that you will, in certain cases, you will go ahead and take a promoter guarantee. But outside that, it's not very different than what a say performing credit would be. So how you enhance returns is by having those warrants built into the structures. But largely from a security perspective, it is pretty much in line with, and with how a performing credit also operates.
Yes. So I missed one question from Mr. Jay D'Souza. How have international institutional investors been accessing this private debt?
So they have largely been coming on to AIS, and these institutional investors and especially offshore investors have been very comfortable with going with an institutional framework, which is via AIF. And there've been a lot of this capital that is coming in, into India via AIFs, and that's how. In fact, we also work closely with them as a house, and we have raised capital from offshore investors to participate. So that's how it largely comes in. There are larger players who even have their own sort of setup here in India, and then they come in via ECB routes. And so there are ways and means by which a lot of this capital gets channelized into India.
The next question is from Mr. Rohan Sureka. Do you expect RBI raising the VRR limit? How easy it is to raise debt under the current non-VRR regulation?
So we believe that the limit will be increased, but again, I would not want to kind of really hazard a guess here. Yeah, there are challenges on the way it is structured right now. But as kind of really scale sort of really comes in, a lot of changes do happen, and that's something that we've seen across the board, not just specific to the VR limits, but even in AIFs and even on the structures, right, that we've done. There are a lot of regulatory sort of so-called changes which have happened, which in certain aspects have been to the extent of a catch-up, while a lot of it is anticipating that this can be sort of really helping the segment sort of really grow. But I would not be able to kind of really hazard a guess here as to will that happen, not happen, when will it happen.
Okay. Next question is from Dr. C. Jayashree. Could you please throw light on the Evergrande Infrastructure Corp in China? In this case, what is the recovery rate?
So in specific to this question, a lot of information, especially for China, is sort of really, you don't have access to a lot of information, let me put it that way. And hence, again, whatever sort of data points that you have and information that you have, basis that it is going to be a little difficult for that whole thing to not sort of really impact the larger economy unless the government sort of really steps in. But that is a limited understanding basis the information that is available. The challenge with China is that you don't have access to a lot of information and data points, and hence, while we believe this will largely be from a global contagion perspective, it will largely be contained to China, and it will not really spill over. But this is basis the information that is available today. Some information which is sort of really not public, then to that extent, I would want to reserve my comment.
Yes. So this was the last question. Is there any other question from the audience? Yeah. So this was the last question, and thank you, everyone. And thank you, Mr. Deepak Malik. It was a very engaging session. Yes, Padmavati, it was a very engaging session. And I'm sure a lot of people and the participants have learned a lot of new things on the private debt sector.
Thanks. It was a pleasure to really interacting with all of you. And again, thank you for taking time out to sort of really listen to us. And so
if anyone wants to get in touch with you, so should I mention the email ID?
Yes, I will put in the chat box. My email ID is.
Yeah. So Mr. Malik has mentioned his email ID. So anyone wants to get in touch with him, you can directly email him. Thank you so much for the session.
Yes. Thank you all.
Yes. Thank you, and have a nice day.